Once a VC once a VC is satisfied with due diligence and would like to go on with investment, they move into structuring the deal, which is the process of negotiating and designing the terms and conditions of an investment deal between the VC and then an early stage startup or a mature startup. This is the first in a three-part video series where I will try to explain all you need to know about this structuring. Now, in this video, I will be covering three different aspects. Firstly, I'll try to explain what a term sheet is. I'll also explain the two main aspects that make up the different terms and conditions that these systems should pay attention to when negotiating term sheet, when structuring out a term sheet, and then which are the economic and then the control terms. And then finally, I'll give insights into the main instrument which VCs consider for investment. As mentioned earlier, deal structuring is the process of negotiating and designing the terms and conditions between a venture capital firm and then a startup. This is where both sides get to balance their different interests. So for instance, whilst a startup will want to raise the maximum amount possible at a higher valuation, on the other hand, the VC will want to provide just enough capital to the startup that enables them to get to their next milestone at a lower valuation. So they tend to balance all of these interests at that particular point where they are negotiating the terms. This lengthy negotiation process that aims to balance the interest of those of the two different parties begins with a term sheet that is issued by the venture capital firm. Now you may be asking the question, what is a term sheet? So a term sheet is a non-binding document outlining the key terms and conditions of a proposed investment opportunity. So by it being non-binding means that both parties are not obligated to follow through with the terms and conditions. So usually it serves as a preliminary agreement between both parties, that's in this case the startup and the venture capital firm involved in that particular transaction. So it kind of provides the framework for further negotiation and eventual drafting of the different legal agreements that eventually becomes binding to both the startup and then the VC firm. Now, in terms of the content of the term sheet, content of the term sheet is going to range from talking about the instrument that will be used for the completing the investment, the amount that is going to be invested, the valuation that is going to, at what valuation, the target ownership stake that is due to the that is going to be due to the venture capital firm, and several other investment terms, right? At this point, I would like to mention that there are certain sections that are binding on both parties, and that is the confidentiality and then the exclusivity clauses. So the confidentiality clauses, it's a requirement to protect certain sensitive information that is going to be shared during the transaction process, right? And then the exclusivity clauses is one that gives the venture capital firm access to the deal for a period of time to conduct the maybe they still need to finalize some aspect of due diligence. So the exclusivity clauses gives them access to that particular deal for that period of time. So it is binding. So at this point, there are so many and there are several terms that are usually negotiated in a term sheet. But there are two broad categories that venture capital firms tend to pay attention to, and that forms the sort of consideration that they make. So the first one being the economic terms, and then the second one being the control terms. Now, what are those economic terms? So the economic terms are those terms that tends to have a direct impact on the sort of returns and expectations of the VC firm if there is a liquidity event. By liquidity event, we can mean that maybe a potential acquisition of the startup or the startup going or initial public offering of the startup. So these are different liquidity events that could potentially help the venture capital firm to get returns on their investment. Remember, no venture capital firm is investing money just for charity. They intend to exit the business at some point in time, get some returns, not just their capital back, but several multiples of their investment. So there are certain terms and conditions that could impact on what sort of proceeds that the VC is going to be getting at the point of exit. So that forms part of the economic terms. And in a later video, I'm going to break that down further. Then the second aspect is now the control terms. Now, because of the risks involved in investing into startups, right, the VC firm will always want to have certain control rights to be able to influence certain key decisions be able to influence certain decisions that will have an impact on their investment, that will have an impact on the success of the business broadly. So there are several different considerations that VC make, like requesting board seats, or requesting to have a seat on the board, right, and several other ones that they tend to integrate. So I'm going to be breaking that down in meta video. However, at this point in time, it is very, very critical for me to talk about the different instruments, the different securities that VC firms tend to use to make investments. So you typically find within the investment space that there are about four of them. Within the startup investment space that there are about four of them, but VCs typically make use of three when they want to invest. So the first one is common stock, the second one convertible notes, the third one safe notes, and then the fourth one preferred stock, or reversing that. The first one common stock, second one preferred stock, the third one convertible notes, and then the fourth one safe notes. So I'm going to be breaking that down further in a bit. Now, common stocks, they are equity securities, right, that provides the holder residual rights to the assets of the business, right? So the thing about common stock, especially within the startup space, is that it is mostly reserved is mostly reserved for the founders and the employees, and sometimes very early investors like family and friends that tend to provide capital to these businesses at that very early stage. So they usually receive common stock. But the thing with common stock is that they don't have the highest priority rights. So they only get to participate in the process of, let's say, an exit after every other person has been settled, right? So they receive consideration lastly. The second one is preferred stock. So preferred stock is also an equity-based instrument. However, unlike the common stock, they tend to have certain rights. They tend to have certain special privileges and control rights that gives them better position when there is a liquidity event. That is to say that they get to receive their own capital, they get to receive certain returns first before common stock shareholders are settled. But the thing with preferred stock is that whilst it allows for some sort of flexibility, especially when it comes to the startup raising larger amounts of money, right, it also comes with several complexities. That means there are certain a lot of legal drafting that needs to be done in the transaction process, and it can be quite lengthy and then costly. So most times for early stage investment is not usually used, but we tend to find it more for, let's say, Series A, as from Series A, Series B round, which are more official price round of the startup fundraising. So because of these complexities, because of how lengthy it can be to raise money using the preferred stock, especially for early stage investment, that is why several other instruments has emerged to kind of bridge that gap between the timing that a startup will need to close out on the funding to get to their milestone, and also managing the cost involved in doing that. So on that note, I'll get to talk about the convertible notes. So just like the name implies, they are initially issued as debt instruments. So by debt instruments, it involves a principal and then it is interest bearing. And in terms of the interest usually range anywhere between 5% to 11%. But the unique aspect as different from the normal debt is that convertible notes can convert into equity. So at certain conversion events, and usually this conversion event is a qualified financing round. What do I mean by qualified financing round? If I'm going to step backward a little bit, most times when startups use convertible notes, usually they are raising a smaller amount of money that is not their official fundraising, but they just need that particular money to get to a next milestone. So once they're able to get to that next milestone, they can then raise larger funding. So usually when they raise a convertible note, that next qualified financing, which is their more official equity raise, becomes the conversion trigger. And usually the convertible note period lasts between 3 months to 1 year. So usually under 1 year. So the startup is expected to complete their qualified financing round within that particular 1 year period for the notes to now eventually convert. Right. And like I mentioned, the convertible note comes with the flexibility of one. It allows the startup a flexible way to raise smaller amount of money quickly and not being encumbered by all the several legal processes that is involved in raising using a prepared stock, right? So that's one. And then number two is that For convertible notes, you don't get to define a valuation at that particular point in time because yeah, this early stage, most times their valuation is not very known. So convertible notes allows the startup and investors to put the valuation forward at a later date when the valuation can be better determined. So more on that part of valuation in subsequent session. So that's for convertible notes. Then the fourth one is now the SAFE. SAFE stands for Simple Agreement for Future Equity. Now, this particular instrument was developed by Y Combinator. Y Combinator is one of the largest accelerators, if not the largest accelerator program in the world. Right. So it's simply a contract that provides investors with the right to receive equity in a startup in a future date, right? Following certain conditions like a conversion, following certain conditions, certain events that will have to happen for them to eventually receive that equity. Right. So similar to the convertible notes, right? At that moment where the investment is completed, it is not an equity yet. So the investor gets to receive the equity at a future date. So for the safe notes, that conversion event could be so many things. It could be either them raising a qualified financing round. It could be a long stop date. It could be a liquidation. Maybe the company is going to be acquired. And once the acquisition trigger happens, all the notes tend to convert into maybe, depending on the agreement, maybe a common stock or a preferred stock, right? So that is pretty much how the safe note works. And similar to the convertible notes, the valuation is not determined at that particular point in time, but it is left for a future time when the startup is better positioned to know what their business is worth. But unlike the convertible note, it is not interest bearing. It does not bear interest, right? Now, in terms of the terms and conditions, the different things that investors tend to look at when they are structuring a convertible note or a safe note, honestly, it's pretty much straightforward. It gets more complex when we are talking about preferred stock. And for convertible notes and then equity and safe notes. So for convertible notes and safe note, the main consideration is number one, the valuation, right? And there are two parts of it. So either looking at it from the aspect of a post-money valuation, a pre-money valuation. So a pre-money valuation is what the business is worth before the investment comes in, and then the post-money valuation is what the business is worth after the investment. So for instance, if a company is raising $2 million, so their pre-money valuation is about 8 million dollars, right? So the post-money valuation is going to be $8 million plus $2 million. So that gives a post-money valuation of $10 million. Now, for certain reasons around dilution and all of that, which we are going to be getting into in a later video, VCs would typically want to negotiate at a post-money valuation. Now, the second aspect of the valuation negotiations is determining what the conversion valuation is going to be, whether it's going to be conversion at a discount or whether it's going to be based off on valuation cap. So what do I mean by valuation cap? So yes, the VC nor the startup may not be able to determine to say, okay, as of today, that our business is worth $10 million or $8 million. Really, the potential is not known. But where a valuation cap is going to be set is that the VC says that, okay, at the time of conversion of either my safe note or my convertible note, that I've capped the valuation of the company at, let's say, $8 million. So what that means is that if the valuation of the business gets to about $20 million at that particular point of conversion, the VC's investment is going to be converting at $8 million, not $20 million. Right. And this, whilst this may benefit the investor, but sometimes it may not be very beneficial to the startups, right? Because imagine a valuation cap has been set at $8 million, but you're able to push your business very hard, and then it gets to a $20 million valuation. They are really going to be underpaying for the business. So the second aspect that is usually more favorable to startup is now setting a valuation discount to say that whatever the valuation of the business is going to be at that time of conversion, to compensate that investor for coming very early at that particular point where the risk is still high, that they are going to be getting a discount, and mostly the median discount is 20%. So that is to say that if the valuation of a business gets to about $10 million. Now, the investors that came in at that safe round or provided or that convertible notes round get to have 8 million, gets their shares converted at $8 million, not $10 million that all the other investors in that particular qualified financing round or that equity round is going to be getting their own equity. So for the it serves as a way of compensating the early stage investors for coming on board at that very early stage, right? Then the other part that tends to form the terms and conditions that are usually negotiated for when it comes to the convertible notes, and then the safe note is going to be around what the conversion triggers is going to be. So what will need to happen, will be those liquidity events that will need to happen for our investment to convert. So what you tend to find is that sometimes, for especially for convertible notes, where a qualified financing round has been set as the conversion trigger, but then the startup is not able to raise the qualified complete raising the qualified financing round within the time frame that is set for the convertible notes to convert, right? So sometimes certain provisions that are being included in the agreements, that if certain such situations occur by majority vote, right, that the convertible note is going to convert to equity. So once that is included, once the majority of convertible holders decides that, okay, regardless of whether they have raised their qualified financing round, that the convertible notes will have to convert to equity, every other participant in that particular and convertible note round will be forced to convert their notes as well. Then the other part is in terms of the investment amount that the startup is that the investor is going to be committing, and then the fourth aspect is now in terms of the type of shares that they are going to be receiving upon conversion. So whilst investors may prefer to receive preferred stock when at conversion, so sometimes this conversion, at the time of conversion, it could be a common stock that they are going to be receiving. So that really are the main areas of negotiation. This convertible notes and the preferred stock, they are pretty much straightforward. I've included some templates of safe notes gotten from Y Combinators and other convertible notes, just in case you want to go through it to gain more understanding about the terms and conditions that are usually included. So having set this foundation, in a subsequent video, because I don't want this video to be too long, in a subsequent video, I'm now going to be talking about all those different economic and then control terms that are included in investment, especially when it is done through a preferred stock, right? So please subscribe to this channel and then turn on your notification button for when I'm going to post that video.